let's look at home prices and wages. Home prices currently are surging 13 times faster than wages. Now remember that discussion of any CUSIP or security is for discussion purposes only. Do not buy any security mentioned in this playlist unless you performed your due diligence. Note that I purchased shares of Lehman Brothers 3 days before it collapsed, so anyone following me into a trade is taking excessive risk and may lose significant financial value. In addition, at the time of this video, I may or may not own shares of the company mentioned and may or may not have kept those shares depending on what circumstances changed. So as a quick note, I do want to point out any financial interest. I have liquidated my S&P 500 holdings. So while the stock market may be roaring up, there is absolutely no economic data that indicates that the stock market anymore is based on, growth or reality or whatnot. Now, I know people will argue, well, it never was, and I actually don't agree. For instance, home prices haven't been outpacing wages 13 times, but this is a major red flag. And in fact, if I was at the Fed, as a case in point, this would be, I wouldn't even wait to raise interest rates. I would immediately start raising interest rates because it's very obvious what's going on underneath this. This is a huge red flag. So we'll get into that in a second. So that being said, there are stocks that I think in the US are underpriced, but the S&P 500 overall, in my opinion, and this is my opinion only, is significantly overpriced. And I made good money, so now it's time to sit in cash. Actually, there's other things that are underpriced, so I'll be probably buying those instead. That being said, let's look at real estate, okay? These are some of the areas that are growing, and you can see the wage growth. This is just a massive bubble anyway. QE has basically kept San Francisco afloat, really. So you can see, this is the home markets, but there's the wages, okay? And here's just a hint about economics. If home prices are outpacing wages, that's exactly what kind of happened before the real estate bubble. That's not sustainable. Now, the reason why the Fed is lucking out right now is because oil prices are down, okay? And this is something that I observed at Wells Fargo. If you have the price of goods falling here and you have the price of goods rising over here, as long as oil prices stay low, you're not going to see much pressure. And if some of these predictions are right that oil prices are going to head to $20 a barrel, I would actually say home prices may continue to rise temporarily. What is it going to look like in the long run is going to be key as soon as those oil prices start heading back up. Okay, but as you can see, this is not sustainable. The wages aren't increasing, so how are these home prices rising overall? By the way, for the record, a lot of this is foreign investors. Detroit, a lot of Chinese are buying there, and in Miami, that's where a lot of Brazilians are buying. And so, once again, you actually have a bunch of foreigners who are behind this, not Americans, right? Not even American investors. That's a problem. They're just throwing money into stuff because they're trying to get a return. These central banks and their desperation of QE has caused investors to need to get a return, and it's outpacing, home prices are outpacing wages big time. So Americans are being priced out of home ownership again, and investors are looking for yield, and real estate provides that yield. I would just like to point out that the Federal Reserve is, if there's any talk in the future of income inequality or wealth inequality, this is all the Federal Reserve. Why doesn't the New York Times point the finger where it belongs? Who's causing this? The Fed. Okay. Remember that high interest rates mean that both investors and the middle class earn similar returns. As stocks become riskier, as does real estate, right? If you're guaranteed a 10% return, why are you going to invest in stocks? Investors earn 10%, so does the middle class. So their wealth grows similarly, right? There's not this wealth inequality that everybody keeps talking about. Look at what low interest rates do is the poor and the middle class don't use leverage like the wealthy do. So then the wealthy use leverage. Then they create a liquidity crisis, and what happens? The Fed bails them out. They've had all kinds of times, by the way, to put these people in Wall Street in prison. That's why I say the Fed needs to go in prison. They've had plenty of time now to actually criminalize these people, right? But they haven't done that. Okay, they've already missed their chance to raise interest rates, at least a year ago, if not longer. No matter what it does, it will be painful. Okay, I guarantee you, if they raise interest rates, or I would say the higher probability if they were to raise interest rates, things are going to get bad. They'll immediately lower them and do more QE. They're not willing to go through bad times, and the irony about the Fed is they're supposed to smooth out the business cycle. 13 times faster than wages is a very obvious. The business cycle is way too high, way too much enthusiasm. Got to retract that. Right? They need to pop that bubble. Okay? They should be meeting today to raise interest rates. They're not going to. If economic data are bad, even with another round of QE, can stocks really go higher? The stock market didn't rise during the recession. Stock investors are taking on significant risk as well, right? They're just betting on the fact, really, that there's going to be more QE. And I agree. Look, I think they're going to kick the can down the road on raising interest rates. I've already said there's a 67% probability that they're not going to raise interest rates this year. But I'd still, if I was going to hold on to the stock market, I would still have to be saying to myself constantly that the economic data that are coming in, which are predominantly negative, don't matter at all. That's a pretty big risk. See, they're masquerading the risk that's really underneath everything. So who knows when it's going to blow up, but when it blows up, it's going to make a mess. And they have had opportunities to prick this bubble. You know, if I was the Fed, I wouldn't want to see the S&P 500 at 2,100 or 2,000 anyway. I would want to see it closer to around 1,200. It needs to be flushed. There's a lot of that's debt and leverage, and it needs to flush. Otherwise, it's going to be unsustainable. You look throughout the history of these boom and bust cycles, and too much debt always leads to a way over boom, and then a bust, and it's always painful, right? Key is to lower the amount of pain. That being said, they've already missed their chance. So things will get ugly. While Keynesians declare victory, the victory is going to be a mess before it's over. One last point. If home prices surge 13 times faster than wages, home prices are assets. That's asset inflation. That's a sign of hyperinflation. See, nobody's talking about this. You're not going to hear this anywhere. But if home prices are surging that fast, that is hyperinflation. Because wages aren't keeping pace with that. You're not seeing it in consumer prices yet. Because one will lead to another, which will lead to another. But all the people who've been declaring hyperinflation 13 times faster than wages, that's a problem. That's a huge, huge problem.